So once again, just to review the balance sheet and then move on to how to do simple double entry accounting. So the balance sheet is a snapshot in time, which means it's as of a particular date. It has assets, liabilities, and equity. And the sum of the assets is equal to the sum of liabilities. We need to remember that because that is how the general accounting equation works. We have current assets, current liabilities, and then the difference between those is what's called working capital. We're going to talk about that a little bit later, but I just wanted to make sure I defined that. In the asset side, we have current and long-term. Current assets are those that are that will be turned over in less than a year, and long-term are those that are longer than a year. The same on the liability side. Less than a year is current, longer than a year is long-term. In equity, there's really generally two types of equity accounts that we're going to be looking at: owner's equity, or sometimes we call it invested capital, and retained earnings. Also remember that when we have entries, they're all positive. Sometimes they'll be negative in the case of accumulated depreciation, but that negative is indicated with the parentheses. So let's look a little bit at what if we have some transaction that happened during the period after we recorded this balance sheet. For instance, what if on April 2nd this company uses $200 of cash to buy inventory? So we're going to take out $200 minus $200 there, and we're going to add $200 to inventory. And we also always have to maintain the accounting equation where assets is equal to liability plus equity. So in this case it would be fine. Cash would end up to be $300 and inventory would be $500. That would be fine, and nothing else would change in the assets and liabilities. This is what generally happens in double entry accounting. There's several types of accounts that you'll be looking at. Always we'll be breaking them into assets, liability, and equity. And there's a list here of possible asset accounts. These are things that the company has in their possession mostly. So cash, marketable securities, accounts receivables, inventory, plant and equipment. Liabilities are things that we owe to others, generally banks, but it could also be private lenders. Or it can be vendors that we owe money to. Like accounts payable would be a vendor account. And then you can see that there's also some other accounts there. Equity accounts, we have generally just a few of them: invested capital, retained earnings, preferred stock, common stock. Also on that particular balance sheet we called it owner's equity, but this is a general account. So there's going to be some important rules that we need to remember when we start recording accounts. We're going to use a T account, which is there on the left, and it's called T because it looks like a T. On the top of it, you can see you put the accounting name, and then on either side you put an increase or a decrease into that account. So if you start building up the account, you enter them all on one side, and then you start decreasing it, you enter on the other side. Now, it's not super easy to just say always increase an account on the debit side or always decrease it on the credit. It's not really that kind of rule. The rule is there in the table that if it's an asset account and it's increasing, you make it a debit account. And then the opposite of true is for liability and equity. Now, most people get a little bit confused about this because of the words debit and credit. When you think about your bank, if you have a debit card, you're actually decreasing your account. But this relates to the entity thing we've talked about before. From the bank's point of view, when you decrease your account, you're not actually decreasing your account, you're actually decreasing their liability to you. So a decrease in a liability is a debit. So that's what you have to kind of remember there, that it's not really the debit in your mind is different than the debit in the creditor's mind. Okay, so we're going to look at how to record some of these transactions in a simple T accounts. A little bit later I'll show how to organize the T accounts, but initially we're just going to look at this. So the first one is that a company borrows $2,000 on a short-term note. So we know we're going to be entering these transactions in a T account. When we borrow money from a bank, what happens is that we give the bank a note, or we sign a piece of paper or a contract that says we will pay them back $2,000. And they give us $2,000 in cash. So we know that the cash account is going to be affected, and it's going to increase by $2,000. So if we look at that table, when we say the cash account is an asset account, so we know that the cash account is an asset account. It's a value to the company, is something we own. And if it's increasing, we look at that and it's a debit, and the debit is on the left side. So I'm going to enter $2,000 to show that the cash account has increased by $2,000 in this T account. Now we know we always have to have another transaction, and it says specifically here that is in short-term notes. A note is a liability, which means we owe somebody something. The company owes somebody something. So in order to determine this, we look at an increase in liability, an increase in what we owe is a credit entry, $2,000. And you notice also that this number is equal to that number. The sum of the debits is equal to the sum of the credits. $2,000 is equal to $2,000. That seems a little bit silly, because of course that would be that way. But that's what we need to always remember, that we have these things balance out when we're making entries. So let's look at the next transaction, which is a customer pays $150 on her account. Now what that means is that a customer got some merchandise and didn't pay it and had like a credit card account. And those kinds of accounts are called accounts receivable. And they are assets to this company, to a company. If a company is owed money by its customers, that's actually a good thing. Now we think, well, maybe what if they don't pay it? That's a different issue. We assume they will pay it, and it's a good thing. It's like an asset. They owe us money. So what happens in this case is she pays $150 on her account, which actually on the account, on the account receivables, that's a decrease in that asset. So a decrease in an asset is a credit entry. So we're going to put $150 there. Now we also know we need to put another $150 somewhere else. So we think about, well, where is that going to be? And the thing is, they paid $150, so we actually have $150 more dollars. So we're going to put $150 as an increase in the cash account of the asset cash account. Okay, now there's going to be another transaction. The third one here is the company pays $850 to a vendor. Now a vendor is somebody who sold you something. So just the opposite occurred when the customer, in our case, we got the merchandise, but we ended up owing them something. So we actually previously had created an account called accounts payable where we owe somebody something. And what's happening in this transaction is we're paying back some of that what we owe. So we're going to take $850 cash, take it out of our cash account, and pay the vendor. So a decrease in $850, and which is a credit to the cash account because it's an asset. And then that means we're going to actually decrease the liability account. A decrease in liability account is a debit entry. So we have $850 here. Now, if that was all the transactions in this accounting period, what we would end up doing is balance these out by drawing lines under them. Now, I'm going to go through the complete accounting cycle later, but if we look at this, what this means is that in this account here, we have $1,300 as a balance. Now we probably had some beginning numbers here, but we didn't include that. But if we just take this, that means we have a $1,300 balance. So that's how we keep track of these accounting, of these transactions through this double entry accounting system. And then later we take these accounts and we transfer them onto the balance sheet.